Welcome back to the Deep Dive. It is Tuesday, January 27th, 2026. And, if you're waking up today, checking your portfolio and feeling this strange sense of calm mixed with a distinct undercurrent of panic, you are definitely not alone. It is a weird, weird day out there.
It is a very strange day. It's what we in the business call a waiting day. But honestly, that feels like a massive understatement. It feels more like the deep breath before a plunge.
Exactly. A plunge. I was reading reports coming out of New York this morning, and the whole vibe is just, it's off. Usually on a Tuesday morning at 9:30 a.m., the trading floors are just buzzing.
Total chaos. In a good way.
Right. Phones are ringing off the hook, screens are flashing red and green, people are shouting over each other. But today, it's a ghost town. It's quiet.
Eerily quiet.
But then you walk 4 blocks away, and the Italian espresso bars, places like Best Sicily or Bottega or Tutto Calcio Espresso, they are absolutely packed.
Standing room only, I bet.
Packed with brokers. They're all just crowded in there, nursing these tiny, powerful espressos, checking their phones, and just waiting. It's such a cinematic image to me.
It really is.
The masters of the universe exiled to coffee shops because nobody wants to make a move.
Well, nobody can make a move, or, at least nobody smart is willing to.
Yeah.
You have to look at what's on the docket for this afternoon. We are effectively in a complete freeze.
Until what?
Until two massive things happen. First, in the afternoon, we have Jerome Powell facing the press after the Federal Reserve meeting. That's the macro picture.
That's a big one.
And second, the moment that closing bell rings, we get the earnings reports from the absolute heavy hitters.
Yeah.
We're talking Meta, Tesla, Microsoft.
The big tech report card.
Precisely. So you have macroeconomic policy on one hand and the corporate profit reality on the other. And both are dropping within hours of each other. So until then, all trading is basically paralyzed.
So our mission today is to, kill time with the brokers at Tutto Calcio Espresso and unpack exactly what they are so nervous about. Because when you look at the headlines we've pulled for today, it's not just your standard earnings jitters situation.
Not at all.
We are looking at a day of just extreme, almost baffling contradictions.
Contradiction is the word of the day. I mean, it really defines the entire landscape right now.
On one side, we have the U.S. dollar crashing to lows we haven't seen in 4 years.
It's a huge deal.
Then we have gold and silver hitting prices that, frankly, sound like they belong in a science fiction novel.
Completely off the charts.
At the same time, you've got SpaceX eyeing an IPO that would absolutely dwarf anything in history.
The biggest ever, by a long shot.
And behind all that, the undercurrent is artificial intelligence, which is literally reshaping global alliances as we speak.
And don't forget the crypto company that's starting to act more like a sovereign nation than a tech startup.
Right. And I still can't believe I'm going to say this out loud. We have Elon Musk potentially making multi-billion-dollar business decisions based on astrology.
Astrological reasons, yes. We will absolutely get to that. It's a wild, wild landscape out there.
Okay, let's unpack this. I think we have to start with the big macro picture because this seems to be the source of everyone's immediate anxiety. The dollar.
The dollar dilemma. That's a good way to put it.
Right. So we're looking at the dollar index, the DXY. For listeners who don't watch this ticker every single day, let's just define our terms here. What are we actually looking at when we talk about the DXY?
Okay, so the DXY is essentially the scorecard for the U.S. dollar. It's not just against one other currency. It measures the dollar's strength against a whole basket of 6 major foreign currencies.
So we're talking mainly the euro, the yen, the British pound.
Exactly those. It tells us how much purchasing power the dollar has on the global stage. It's the big benchmark. Right now, that scoreboard reads 96 points.
96. And to put that in context for everyone, that is a 4-year low. We have not seen these levels since March of 2022.
That's correct. And to give that even more context, that's an 11% drop in just the last 12 months.
11%. For a reserve currency, that's not a dip. That is a massive slide.
It's a cliff.
Now, here is the part that I'm struggling to connect. I need you to walk me through this. Usually, if a country's economy is doing really well, their currency is strong, right?
That's the textbook theory, yes.
People want to invest there, so they need to buy the currency to do it, which drives the price up. The U.S. is currently the fastest growing major economy in the developed world, so why is the dollar in the toilet?
That is the multi-trillion-dollar question, isn't it? In a perfect textbook scenario, you are absolutely right. Growth equals a strong currency. But we aren't living in a textbook 2026. We are living in a crisis of confidence.
Confidence in what, specifically? The economy's growing.
Confidence in stability, in governance, The sell-off we're seeing right now, it isn't really about growth, it's about governance. There is a tremendous amount of uncertainty about U.S. economic and trade policies.
And investors hate uncertainty.
They hate it more than they hate bad news. A predictable loss is better than a chaotic unknown. On top of that, you have a Federal Reserve that is seriously diverging from the rest of the world.
How so?
Other central banks are tightening up or at least holding steady in a very hawkish, anti-inflationary way. But the Fed has been surprisingly accommodating. It's been cutting rates.
So money is just flowing to where it gets a better, safer return.
Exactly. But there's a bigger, much darker cloud hanging over all of this, and that's the debt. We have officially hit $39 trillion in national debt.
39 trillion. It's a number so big it almost loses all meaning. You know, we hear it so often. It was 34, then 35, now 39. Does the market actually care anymore, or is it just background noise?
Oh, they care. They start to care when the currency starts sliding like this, because at that point, it stops being some abstract number on a government website, and it starts being a solvency issue.
A solvency issue. That's a strong term.
It is. Robert Kaplan, the vice president at Goldman Sachs, made a very telling point about this recently. He said, sure, a weak dollar usually helps exports. It makes American goods cheaper for foreign buyers. That's the silver lining we're always told about.
The classic argument.
Right. But he warned that when you have $39 trillion in debt, currency stability is actually much more important than a temporary export boost.
Why is that? Break that down for us. What's the mechanism there?
Because the entire U.S. government, the entire system, relies on foreign nations, China, Japan, Europe, to buy that debt. They buy our treasury bond.
They loan us money to keep the lights on.
Precisely. Now, if those buyers stop trusting the dollar as a stable store of value, if they start to think the dollar is a wasting asset, as some are calling it, they just stop buying the debt.
And what happens then?
If they stop buying, the U.S. has to raise interest rates sky high to attract them back in. And that would absolutely crush the domestic economy. Mortgages, car loans, business investment, it all grinds to a halt. So Kaplan is saying we can't afford a weak dollar anymore. We need global confidence just to keep the debt machine running.
And that leads us directly to the political side of this, because you can't talk about the dollar in 2026 without talking about the administration. We've seen repeated political attacks on the independence of the Federal Reserve, which markets absolutely hate.
They despise it.
So what is Donald Trump actually saying about this dollar crash?
He's dismissing it entirely. He was asked about the dollar slide just yesterday, and he called it a yo-yo.
A yo-yo.
Seriously, his words. He said it goes up and it goes down, but ultimately it's finding its fair value. He claims businesses are doing great and that the dollar is great.
So nothing to see here.
Nothing to see here. He actually pivoted immediately to attacking China and Japan, bringing up his old arguments that they used to devalue their own currencies to hurt U.S. manufacturing. So his stance is essentially, don't worry about it. This is just the market finding its level.
Which feels a little bit like looking at a massive leak in the hull of a ship and saying, don't worry about the water, it's just finding its level inside the boat.
It's a very risky stance, and the major global institutions are definitely not buying it. Kristalina Georgieva from the IMF, the International Monetary Fund, came out yesterday with a pretty stark warning.
The IMF is a big deal. What did she say?
She said the IMF is actively preparing for a rapid sell-off of dollar-dominated assets.
Oof, rapid sell-off. That sounds ominous. That sounds like a bank run, but for a country.
It is. And they are conducting stress tests. When the IMF starts stress testing for a run on the dollar, you really should pay attention. They're essentially simulating a doomsday scenario where the world decides to dump the dollar all at once.
And we are seeing the flip side of this in other currencies, right? If the dollar is down this much, everyone else must be way up.
Correct. It's a seesaw. The euro has broken that big psychological barrier of 1.2. That's the highest it's been since 2021.
And the pound.
Sterling is at 2021 highs as well. The Swiss franc is at levels we haven't seen since 2015. Everybody is strengthening against the dollar.
Which, you know, sounds great for them on the surface, but isn't that a huge headache for a place like Europe?
It's a massive headache. It's a classic be careful what you wish for scenario. If the euro is too strong, European exports, we're talking German cars, French luxury goods, Italian machinery, they all become incredibly expensive for the rest of the world to buy.
So their biggest customer, the U.S., suddenly can't afford their stuff.
Exactly. So while the U.S. is suffering from a confidence crisis, the ECB, the European Central Bank, is suddenly suffering from a competitiveness crisis.
Yeah.
It's a messy global picture with no easy answers.
So, okay, let's go back to that broker in the espresso bar. You're sitting there, You see the dollar crumbling, you're worried about the 39 trillion in debt. Where do you put your money for safety? Apparently, the answer is shiny rocks.
The oldest safe haven in the book, gold and silver.
Let's talk about this new gold rush, because rush feels like a complete understatement. Gold is trading above $5,200 an ounce.
It's a historic record. $5,200. I mean, people were calling for $3,000 a few years ago and they were laughed at. Now we've blown past $5,000.
It's incredible. And what about silver? The poor man's gold.
Silver has surged 8% just recently. It's sitting at $114.43. And it gets crazier. Citigroup just upgraded their target price for silver. They think it's going to do $150.
$150.
Yep. That's a potential 40% upside from where we are right now.
That is absolutely wild. But here is the fascinating social shift inside this data that I want to dig into. You mentioned earlier that Wall Street insiders are seeing a real changing of the guard regarding who is buying all this gold.
This is one of the most interesting sociological shifts in the market right now. It really is. For the last decade, maybe more, the narrative was really clear.
What was it?
It was. Boomers buy gold, millennials and Gen Z buy crypto. Gold was seen as a pet rock for old people. It was an analog asset in a digital world. Bitcoin was the new digital gold.
Right. If you were under 40, you just didn't touch bullion. It was your dad's investment.
Exactly. That entire narrative is flipping on its head.
Yeah.
We are seeing a massive rotation where the younger generation of traders and investors is moving out of crypto and into physical gold. They are seeking something tangible.
Why do you think that is? I mean, maybe they've lived through one too many crypto winters. Or maybe they're just looking at this AI-generated world and saying, I want something I can actually hold in my hand.
I think that's a huge part of it. When everything is digital and can be faked or hacked, the physical becomes the ultimate premium. And the numbers, they absolutely back this up. Gold ETFs saw record inflows in 2025.
How much are we talking?
$88.6 billion flowing into gold funds last year alone. And that's not just central banks buying, that's retail. That's the younger generation.
But speaking of crypto, we have to talk about Tether, because this story just blurs the line between the old world and the new world in a way that, frankly, blows my mind.
It's an incredible story.
Okay, so for those who aren't deep in the crypto space, Tether is a stablecoin issuer. They make these digital tokens that are supposed to be worth exactly $1. They're like the plumbing of the crypto ecosystem.
Correct. They provide the liquidity for traders.
But they are now acting like a sovereign nation.
They are acting like a central bank. Tether has become a major player in the physical gold market. This isn't a crypto story anymore. They are on the front page of Bloomberg for a reason.
Okay, so just how much gold do they actually have?
As of the latest filings, they currently hold 140 tons of physical gold.
140 tons.
Yep. And at today's prices, that is valued at roughly $23 billion.
That is just staggering.
And they aren't stopping. Paulo Ardoino, who's the CEO of Tether, he confirmed on the record that they are actively buying 1 to 2 tons of gold per week.
Wait, hold on. Let me wrap my head around this. A private company that issues digital tokens on the internet is now one of the single largest buyers of physical gold bars in the entire world.
Yes, that is exactly what is happening. They are backing their digital empire with the oldest hard asset known to man. It's almost like a return to the gold standard, but it's being run by a private crypto company instead of a government.
And they are making inroads into the U.S. system now, too.
They are. Just yesterday, they officially launched in the U.S. with a new coin called US8.
What is USA?
That's another dollar-anchored coin like their main one. But this one is specifically built to be compliant with all U.S. federal rules and regulations. They're calling it the dollar on steroids.
So you have this private entity that is now compliant with U.S. regulators, but is also hedging its own existence by hoarding physical gold like a dragon in a cave.
That's a perfect analogy.
It really does feel like the old rules are just, I don't know, dissolving. You have the U.S. government ignoring its debt and a crypto startup hoarding gold. The whole world feels upside down.
It is. And if you think that's futuristic and strange, we haven't even touched the tech sector yet. Because while the macro picture is all gloom and doom and dollar crashes,
the tech world is partying.
The tech world is partying like it's 2026.
Yeah. Okay, let's go there. Let's pivot from the fear trade to the hope trade, specifically the chip makers and the space explorers.
The supply crunch is the big story here. Let's just look at Micron. Their stock is up 5% today following some big investment news out of Singapore.
And what's the driver there? Is it a new product?
The driver is simply scarcity. It's economics 101. Micron is now predicting that the global supply crunch for advanced chips is going to last until at least 2027.
2027, so 3 more years of this minimum.
Minimum. Demand from AI, from cars, from phones, it is simply outstripping humanity's ability to manufacture these things. We literally cannot build the factories fast enough.
And we're seeing this in other stocks too. Core.
Core is another great example. It's up 11% today. But get this, it's up 52% just in the month of January.
52% in 1 month. Is that bubble territory, or is that actually justified?
Well, the market is arguing that it's justified, because if you make the essential hardware that powers the brains of the future, you basically own the toll road. And investors will throw almost any amount of money at you to own a piece of that toll road.
But there's a massive geopolitical angle to this as well, isn't there? Specifically with Nvidia and China. We've been hearing about these export bans to China for years now. You can't sell the high-end stuff to Beijing.
We have. It's been a constant back and forth. But commerce finds a way. The latest news is that China has just approved the first batch of Nvidia's H200 chips.
The H200, I thought those are the ones that were specifically restricted.
It's a very complex dance. The Trump administration has these rules in place requiring 25% of sales to go to the administration or be heavily overseen. It's a mountain of complicated regulatory tape. But the headline is this: China demands them.
What's the demand like?
Demand has hit 2 million units. And even though Nvidia said, hey, this wasn't in our official guidance, the market sees that number, that 2 million units, and it just goes wild.
Because it proves the demand is insatiable.
It proves that the AI arms race is now transcending trade wars. Everyone needs the chips, no matter what the politicians say.
Absolutely. And speaking of the AI arms race, we have to talk about Sam Altman and OpenAI.
The man who wants all the money in the world to build God.
Pretty much. The latest reports say SoftBank is ready to invest another $30 billion into OpenAI.
Another $30 billion. And you have to remember, that comes right after reports that SoftBank dumped. They sold off a huge chunk of its Nvidia stake.
So they're selling the shovels to bet on one specific gold miner.
That is the perfect way to put it. Masayoshi Son is selling the hardware winner to bet everything on the software winner. He's moving his chips, pun intended, all in on Sam Altman.
And Altman himself is aiming to raise a total war chest of $100 billion.
$100 billion.
That is nation-state level spending. That's more than the GDP of many countries.
It is. They're literally rearranging the furniture of the global economy to bet on this one company, this one vision of the future. The scale is hard to comprehend.
It is staggering. But, if we are talking about staggering sums of money and visionary or maybe just crazy CEOs, we have to talk about SpaceX.
The final frontier of finance.
The Financial Times is reporting that SpaceX is officially readying for an IPO in June. And the numbers they're talking about, they are aiming to raise $50 billion.
$50 billion.
Yeah.
If they pull that off, it would be the largest IPO in human history.
Larger than who? What's the current record?
It would surpass Saudi Aramco. It would be bigger than the state-owned oil giant of the 20th century.
Which is just so poetic, right? The oil giant of the past versus the space exploration giant of the future. It feels like a movie.
It really does.
But there's a detail in this report that I can't get over it. It's the timing.
The June date, yeah.
Why June? Is it because of fiscal quarters? Is it about market conditions? Is there some strategic reason?
According to the Financial Times sources, the timing is reportedly chosen for astrological reasons, favored by Elon Musk.
You have to be kidding me. Please tell me you're joking.
I am not.
So the biggest financial event in history involving the pension funds of millions of people and sovereign wealth funds of entire nations might be scheduled based on the alignment of the stars.
Look, with Musk, you never know where the eccentricity ends and the genuine strategy begins. Maybe he likes the alignment of Mars for rocket launches. Maybe it's just a joke to troll the SEC and the financial press.
But when you're raising $50 billion, even a joke moves markets.
That's the thing. It doesn't matter if he's serious or not. The story is out there now.
But to be fair, there is a very tangible, very real-world reason for this massive valuation too, right? It's not just rockets and astrology. It's about phones.
Correct. This is the real meat of the valuation. The information is reporting that the iPhone 18 Pro, the next big Apple flagship phone, will integrate Starlink connectivity directly into the device.
Whoa. So no more dead zones, ever.
Theoretically, yes. If Apple integrates SpaceX satellites directly into the iPhone's hardware, you have a customer base of billions of people instantly connected to Musk's network.
And every iPhone user becomes a potential Starlink subscriber.
Exactly. That turns every iPhone user into a recurring revenue stream. That is a massive, massive upside. And frankly, that explains the $50 billion target much better than astrology does.
I don't know, I kind of like the astrology angle better. It adds a bit of flavor to the finance.
It certainly does. It keeps things interesting, that's for sure.
Okay, let's bring it back down to earth for a minute. Specifically to the mechanics of Wall Street. Because while all of tech is flying high on these dreams of Mars and AI, the rest of the market, the boring, real economy, is feeling a serious drag. We're seeing a clear rotation.
A classic rotation.
Right.
For the last 5 days, we've seen the NASDAQ, which is super heavy on tech, outperforming everything else by a wide margin. Meanwhile, the Dow Jones Industrial Average is lagging.
And the anchor that's dragging the Dow down is health insurance. That seems random.
Health insurers, yeah. And this is a direct result of government policy. Trump announced that the reimbursement rates for Medicare Advantage are going to remain stable.
Now, to a normal person, stable sounds good. Stable is safe. Why did the market panic and sell off health insurance stocks?
Because in political speak, especially during a time of inflation, stable means a cut. Think about it. The cost of doctors, the cost of prescription drugs, the cost of administration, all of that is going up by 3, 4, maybe 5% a year. If the government's reimbursement rate stays flat with a 0% increase, your entire profit margin just disappeared.
I see. So flat is actually a loss in real inflation-adjusted terms.
Exactly. And this is a huge deal because Medicare Advantage is essentially the privatization of senior health care in America. It's a massive industry.
And for context, this isn't some niche part of the economy.
Not at all. We often forget this, but Americans, on average, spend more money on health insurance premiums than they do on their mortgages.
More than their mortgages. Wow.
It's a massive chunk of the economy. So when the government effectively cuts the race for that industry, the market shudders. And that's why the Dow is so heavy today.
So we have the Dow being dragged down by healthcare and the NASDAQ being propped up by the so-called Magnificent Seven.
The usual suspects, Meta, Microsoft, Tesla, Apple, Amazon, Alphabet, Nvidia, all reporting soon.
And what are the expectations for them this afternoon when they report their earnings?
The expectations are very high. Profit estimates are expected to grow by an average of 20%. But the number everyone is really watching isn't profit. It's capex, capital expenditure.
Yay. Spending money to make money? Building for the future.
Spending ungodly amounts of money is more like it. Their collective capex is expected to top $470 billion in 2026.
$470 billion.
That's up from $350 billion last year. They are spending nearly $500 billion in a single year, building data centers, buying AI chips, and launching satellites.
That's a lot of pressure. They have to prove to Wall Street that all this spending is actually going to generate returns down the line.
Exactly. Investors are starting to ask the tough questions. You're spending $50 billion on AI servers. Show me the revenue. And Morgan Stanley pointed out another big risk here. Debt.
They're borrowing to fund this.
Heavily. There is an expected $400 billion in new investment-grade debt issuance for 2026 just from these companies. They are borrowing heavily to fund this growth. And if interest rates don't come down like they hope, that debt gets very expensive very fast.
Which sort of brings us back to the Amazon oopsie this morning.
The accidental email, yeah.
Amazon accidentally sent out an email announcing further job cuts, on top of the ones they already did.
On top of the 14,000 they announced back in October, yes. It looks like someone in HR hit send a little too early. It's a PR nightmare, of course, but it also signals that even these giants are trying to trim the fat to help pay for that $470 billion capex bill.
That's a stark way to put it. They're firing humans to buy GPUs.
That's the reality of the AI transition.
Okay, let's zoom out again. We've looked at the U.S. Let's look at the global picture and bring the Fed back into this.
Yeah.
You called this Fed meeting a very boring meeting in very interesting times. Why?
It's a great description for it.
Because nobody actually expects them to move the rates today, right?
Correct. After 3 previous rate cuts, the universal expectation is a pause. They're going to hold steady.
So if nothing's going to happen, why is it interesting? Why is everyone at Tutto Calcio Espresso sweating over it?
Because of the incredible dilemma the Fed is in. They're essentially playing a game of chicken with the economy. They're waiting to see what breaks first.
What are the 2 things that could break?
On one side, does inflation start rising again because of all this government spending and the strong economy? Or, on the other side, Does the labor market finally start to slow down and tip us toward recession? They are stuck right in the middle, and they're terrified of making the wrong move.
And there is a huge political shadow looming over this meeting, too, isn't there?
A massive one. Trump has been very, very vocal. There is rampant speculation about who he is going to nominate as the next Fed chair. He wants someone who will cut rates much more aggressively.
So Powell is sitting there trying to maintain this image of independence.
While the White House is effectively interviewing his replacement in public on cable news. It completely undermines the Fed's credibility.
And while the Fed sits completely still, Japan is confusing me.
Japan is the big anomaly right now. It's the outlier.
Okay, so we said earlier the dollar is crashing against almost everything. The euro, the pound, the Swiss franc. But it is actually rising against the Japanese yen. The yen is weak. Why is that?
It's a policy divergence. The Bank of Japan is still incredibly accommodative. But the scary part here, the part that could impact everyone, is the threat of intervention.
Intervention?
Yes. The Japanese finance minister, Katayama, came out and said they are ready to intervene in currency markets and that they will do it in coordination with the U.S.
Okay, so what does that mean for us? Why should a listener in Ohio or Texas care about the value of the yen?
Because of something called the carry trade. Now, this is a term that makes most people's eyes glaze over, but it is absolutely critical to global stability.
All right, break it down for us. Simple terms.
Okay. Imagine you can borrow money in Japan for basically free, 0% interest. You take that money, you convert it into U.S. dollars, and you use it to buy U.S. stocks or bonds that are paying you 5% or 10% returns.
So it's free money. It's pure arbitrage.
It is free money. And Japanese investors have done this to the tune of $2.2 trillion.
Wait, $2.2 trillion of U.S. assets are currently owned by Japanese investors who bought them with borrowed yen.
Correct. But here's a massive catch. This whole trade only works as long as the yen stays weak. If the yen suddenly strengthens, if the Bank of Japan intervenes and pushes its value up, the money you borrowed suddenly becomes much more expensive to pay back. Your profit evaporates overnight. You panic.
And you sell all the U.S. assets to cover your loan.
Exactly. You dump the U.S. stocks, you dump the bonds to get dollars to pay back the now expensive yen loan. If all those Japanese investors decide to repatriate that $2.2 trillion all at once, it would be a liquidity shock to the U.S. market that would make the 2008 crash look like a minor hiccup.
It's a massive bomb just ticking in the background of the global financial system.
That's what it is. It's a huge systemic risk. So yes, we are watching the Fed for rates, but we should really be watching Japan for a potential liquidity shock. That is the real danger zone today.
Wow. Okay. Meanwhile, Europe is looking elsewhere for growth. I saw news about a massive new deal being finalized between Europe and India.
This is a huge geopolitical shift. They've signed a free trade agreement, creating a single market of 2 billion people.
2 billion customers. That's a lot.
It's a game changer. European exports to India are now projected to double by 2032 because of this. And the big winner, potentially, is the European automotive sector.
European cars in India, like BMWs and Mercedes.
Well, that's the dream. But it's a really tough market to crack. The Indian market demands cheap, compact, rugged cars that can handle their roads. A luxury European car is a tough sell to the mass market there. But just opening the door is a huge strategic win for Europe, especially as they try to rely less on China and the U.S. as trading partners.
Speaking of Europe, can we get a quick check on the luxury sector? I know we always track LVMH and Ferragamo as key indicators of global wealth and consumer sentiment.
It's a mixed bag right now. LVMH saw a general slowdown in 2025 overall, but, and this is the key detail, their Q4 numbers showed very positive signals coming out of China. The high-end Chinese consumer is waking up and spending again.
Okay, that's a good sign. What about Ferragamo?
That's the other side of the coin. Their revenues were totally flat, $282 million. They reported real weakness in Europe and the Middle East.
So what does that tell you?
It shows that the aspirational shopper, the person saving up for one nice thing, is still hurting from inflation. The super rich buying LVMH are coming back, but the middle is still squeezed.
Before we wrap up the global tour, I do want to touch on a specific corporate governance story you flagged out of Italy. It seems a bit niche, but you said it was important. The banking situation with MPS.
Monte dei Paschi di Siena.
Yes.
It's the oldest bank in the world, and it's been a basket case for years.
Right. So what's happening there now?
The board of directors is meeting today to form the list of candidates for the board renewal. The big shareholder vote is on April 15th. The key detail here is about Lavalio, the current CEO.
He's the guy who finally turned the bank around,
Oh,
right?
he's the hero, yes.
Okay.
He will not participate in forming the list of new candidates. That's to avoid any conflict of interest. But he could be placed on the list by others and be voted for.
That seems oddly polite and formal.
It is. It's a very delicate, formal dance of corporate governance. And I flagged it because it shows how incredibly scrutinized and rule-bound European banking is right now.
And the contrast is just so stark. In Italy, they are debating the minutia of who can sit on a committee to make a list for a vote.
While in crypto land, a private company is buying tons of gold bullion a week. And in America, a car company is launching satellites and timing the biggest IPO in history based on astrology.
It really highlights the two different speeds of the world economy right now, doesn't it? You have the old world with all its caution and rules versus the new world with its sheer, unadulterated audacity.
That's a perfect way to describe it.
So let's try to synthesize all of this. We've covered a lot of ground here today.
We have. It's been a dizzying morning.
We have the dollar index at 96, signaling a major loss of faith in U.S. stability. We have gold at an eye-watering $5,200 and silver at $114, showing a desperate flight to tangible safety.
The fear trade? Absolutely.
And then on the other side, we have SpaceX seeking $50 billion to connect the iPhone 18 to the stars and SoftBank throwing $30 billion at OpenAI.
The hope trade. Maxed out. And in the middle, you have the Fed, completely paralyzed between inflation and recession.
It really feels like the entire world is just hedging its bets.
That's the perfect way to put it. The world is actively hedging against the U.S. dollar. They're doing it with gold, with silver, with certain cryptos, while simultaneously betting the house on American innovation, on SpaceX, AI, and chips.
It's like saying, I don't trust your currency or your government's balance sheet for a second, but I absolutely love your rockets and your algorithms.
Exactly. It's a completely schizophrenic market. We don't trust the government, but we implicitly trust Sam Altman and Elon Musk to invent the future and make us all rich.
So here's the thought I want to leave our listeners with today as they wait for the afternoon's fireworks. We talked about Tether acting like a central bank. We talked about SpaceX timing its IPO based on the stars. We talked about a $39 trillion debt that nobody seems to have a credible plan for.
Right. All these broken models.
It really feels like the old rule book, the one they teach you in MBA programs, the one that says efficient markets and rational actors is officially dead. It's been thrown out the window. If a private company is the new gold standard and a car company is basically an astrology-based venture capital fund, are we just making this all up as we go along now?
We might be, and that's what makes today so terrifying, but also so interesting. The old maps are useless.
So if you are listening to this, keep a very close eye on the Fed meeting this afternoon. But don't just watch the interest rate number. That's not the story.
No. Watch the language. Listen very carefully to how Jerome Powell talks about the dollar. Listen to his tone. Is he confident? Is he worried? That is where the real story is going to be.
And maybe, just maybe, go buy yourself a little piece of silver, just in case.
Couldn't hurt to have a hedge.
Thanks for diving in with us. We'll be back tomorrow to break down those huge tech earnings and see if the astrology paid off.
See you then.